Well, here we go, the most popular video series that I do on the channel, the stocks that I'm buying, January 2024 edition. And for you guys that are wanting the UK stocks, don't worry, I'll do them in a few days time. But these are stocks that I've been buying on the US market, and as always, I do this video series every month to keep up that transparency. I've done it for many years, so you know exactly what I'm buying and exactly what I'm selling. I'm not hiding anything in the background. I'm not selling something quietly out in the background that hasn't worked out. I'm not suddenly buying something and then selling it and buying back in and going, look how low my average is, it's absolutely amazing. Nothing like that. We've kept up the transparency even through the great reset, the bear market for the last year and a half, and now we're entering the bull market. These are my updated stocks that I've been buying. So as always, I hope you enjoy the video. Hit that like button. Let's get started. Now, it's mentioned that all these stocks I'm buying are for long-term holds. There's no day trading, no swing trading. It's all about holding it for the longer term. But before we do get on the stocks, just a quick little plug. If you do want to join the Patreon, £5 a month, you get 2 exclusive videos on there, and as well as that, you get to know what I'm buying and selling in real time on there. And of course, you support the channel. So for £5 a month, I don't think it's too bad at all. And if you want some free shares and you're looking to start investing, join Trading 212. That's the broker that I use. You join through the link in the description. You can get a free share worth up to £100. So the first stock on the list is Imode. Now, I can't believe Imode is actually on this list. If you asked me a few years ago if I would see Imode at $22, I would have said no chance. But it's there, and now it's there. I'm taking that opportunity to buy some more shares in Imode. Imode actually had a poor year last year. It was a stock that suffered and underperformed the market, but I am buying this opportunity. Now, I have been an Imode shareholder for around about coming up to 4 years now, which is absolutely crazy to say. I started buying after the IPO, went a little bit stagnant after its IPO. The stock then did run up absolutely massive. I was selling shares out at 300% profit, and I thought I'd never see the days of $22 again, but it's happened, and the stock has created massively since that time frame. And I think now this sell-off is way too much for this company. Trades at 10 times earnings, which I think is massively good for the risk to reward for buying the company at the moment. And if you don't know what Imode do, they are a non-invasive company for appearances. So we know people are being a little bit more cautious about the appearance. And the big thing is that people do not want to go under the knife. They don't want to get put to sleep, but they want to make their appearance better. So Imode is that company where you don't have to go under the knife. You don't have to get put to sleep. People don't want that to happen, but they want to maybe change something about the appearance. So an example is one of the products to have is the Morpheus, and if you look at the before photos, and if I slide it to the left and slide it to the right, you can see the difference between the before and after photos. And there's plenty of products they have down here. So they do sell this equipment so the providers can do this, as well as that they do have revenue that is more reoccurring as well inside the business now, which is a great addition in the last 2 years. Now, the reason why the stock is down so much is because, first of all, there was the war going on in Israel, and obviously when they're a company based in Israel, I think people got a little bit worried about that and then sold the stock off. So that is one reason why the stock is down. The other reason is they have come out with a profit warning. So if we do have a look at the revised full year results, they did downgrade their revenue from 500 million, from 510 million down to 485 million. You can see here that they also downgraded their non-GAAP earnings from $2.53 to $2.57, all the way down to $2.47 to $2.50. Now, I just said all the way down. It wasn't that much of a downgrade, but it was a downgrade. And I think the market has overreacted with that. Because if you do look at the revenue and the non-GAAP from last year, you'll see here that they're actually still growing on the revenue point of view this year and from the non-GAAP point of view. So even though it's been a downgrade, they're still moving into growth, which is still very good. Now, the reason why the downgrade happened on the guidance isn't really much to do with Imode. The problem is these machines they sell, like the Morpheus, for example, these cost thousands of pounds. Now, if you're a doctor wanting to get one of these machines to use, obviously it's going to be quite hard for you to buy them outright. So what you have to do is you have to go get a loan. What do we know what's happened in the last 12 months? Interest rates have gone sky high and it's affected the business. So I can understand why the business is performing not as well at the moment because interest rates are so high. Now, Imode themselves are trying to help with the actual lending side of the money. So they're trying to resolve that and help their clients actually with getting a loan to buy the equipment. As well as that, what do we expect to happen? Interest rates are supposed to come down. So the fact that they've still been doing decent financials in this time frame in a higher interest rate environment, that gives me a lot of confidence. And once again, like I said, 10 times earnings, I think a lot of that is baked in the risk side. Now, if you look at the company, you'll see the growth that they have had, and they should go back to growing once the interest rate environment does calm down. And I'm sure some of you eagle-eyed viewers will be able to notice suddenly the profitability margins. Yes, this company throws off very good amounts of profitability. So we can see here next year, analysts are expecting the company to go back to growth, and they're expecting 201 million on earnings. Now, obviously, what's that going to do to the balance sheet? You're going to have a lot of cash sitting on that balance sheet. So they've got no debt on there. And you can see here, they currently sit on 675 million. Obviously, by the end of the year, that will be even higher. That will be towards 875 million of cash, which is half of the market cap. Now, this is where Imode has had some stick, and it has some stick for me because I feel like they should be using the cash. Personally, I think they should be buying back shares. Imode have come out and said we don't want to buy shares because we don't think we get the rewards from it, which I do totally disagree with Imode on this one. It's the one big thing that I disagree with them. But they are currently looking for an acquisition. And last time we heard, they have identified some companies that they could potentially look to buy. They have actually put some offers in, but they have been previously rejected with the offers. But there is 2 new targets identified. So they are looking to do something with that cash. And when they do use something like cash, if it's a buyback, obviously that'd be very good for the shares. The other thing is, if it is an acquisition, what you're going to see here is that's going to add a lot of more, hopefully, revenue and profitability to the business, and obviously that will make the company look even cheaper. So I do like Imode at the moment from a risk to reward point of view massively. So I have been buying some Imode. The next one is Walgreens. So Walgreens is more of a turnaround play. I feel like the company has suffered from the CV situation, the growth in competition from the likes of Amazon, and as well as that, it has been mismanaged in the last few years. But hopefully, using that legacy brand they do have, they are able to get back up to some growth. Obviously small amounts of growth and also some profitability, and as well as that, I'll also be collecting hopefully a dividend. Now, I believe the dividend could get cut, but we'll see what happens there. Even if it gets cut, it could still be a healthy 3-4% dividend yield. It is worth pointing out that Walgreens will actually be reporting earnings on, I think it's Thursday, so a lot of this information will go out of date very quickly, so I'll keep this nice and brief. But Walgreens have now appointed a new CEO in as well, so that's something to point out. Walgreens, I'm sure you are aware of, obviously own a lot of pharmacy stores in the US as well as Boots in the UK, which they could potentially be selling actually, and that could potentially generate some cash for them and also help the debt on the balance sheet, which they have been paying down. Now, Walgreens has had competition from the likes of Amazon, but I think there's still going to be, when you are ill, you want to get something straight away. So Amazon is great for maybe 24 hours, but if you need Walgreens, you're still going to need that kind of in-store to get something very quickly. And Walgreens have been using their stores to help with combating Amazon. So they've had curbside pickup, and also you can have delivery from Walgreens as well. So they've been using those stores to try and use their delivery service to beat Amazon to help the competition. And as well as that, Walgreens are going to be using some cost-cutting strategies as well to try and drive up the profitability. In the recent quarter, they did say they are going to try do a 1 billion saving strategy as well inside the company. Now, the recent earnings weren't too bad. There was a slight miss on the EPS, but you can see here revenue growth was up 9%. So the company is growing at good rates. It just needs to manage its profitability, and hopefully, like we said, the 1 billion in cost cutting hopefully starts driving up the profitability. And at the moment, analysts are forecasting that profitability will mean that this trades at a forward PE ratio at 7 times earnings, which I think does price in some of the risk with this one. Next one is Alibaba. So I have bought some more Alibaba. I wasn't planning on to, but the fact that it's now sitting at $77 range just makes me go, I've just got to buy some now. And Chinese stocks, I mean, they've just not been loved, have they? For the last really 3-4 years now, they've just been on a massive downtrend. I thought last year potentially we see the kind of, with the market going more risk on, I thought some investors would come into the Chinese stocks, which hasn't happened. But I think it has to at some point. Now, I've been an Alibaba shareholder for quite a while. I was a shareholder in 2018 when the last situation happened with Chinese stocks, when they had a bit of a slump. Bought some shares, rode the stock up to 2020, sold off half my position, and I thought I'm just going to leave the rest of the shares to go up nicely. that didn't happen. The shares took a big nosedive, and in fact they've been going lower. So I thought I'd buy some shares up here. Same again at 10 times earnings. I think this has priced in a lot of the risk to reward here. Alibaba, if you don't know, they basically, if you live in China, you're going to be using some of their products, potentially even more than one product. They own all of these brands here, as you can see, whether that be through shopping, through healthcare, through maps, through entertainment. They own a lot of products in China. Now, if you look at the recent earnings, this is what I mean, like at 10 times earnings. I look at the recent quarter and it was good. Like the market took a bit of a slump on the quarter because they were a bit disappointed with the cloud and it wasn't going to get spun off. But outside of that, when you actually dig into the numbers, which is the most important part, I actually thought the recent financials from Alibaba were decent. The revenue growth was 9%. If you look at the income from operations, it was up 34%. If you look at the adjusted EBITDA, that was up. Adjusted EBITDA margin was up as well. From a net income point of view, it went from a loss of 22 up to 26 billion, which is a really good improvement. So all these numbers are showing really good signs of improvement. This is really good improvement from Alibaba from where it was dealing with opening up and locking down all the time from the pandemic we had a few years ago to now actually putting in very good numbers. And the fact that this now sits at 10 times earnings and putting these numbers, it is very good. Even when you weigh in the point of view that it is a Chinese stock, so there's going to be a discount on the valuation because of it being a Chinese stock. These numbers are still very attractive, and when you start working on a forward basis now, it's even going to drop down to a 7 times earnings, which is just absolutely nuts. And then you start looking at the growth that analysts are predicting as well. Obviously should go back to 10+% a year growth. Obviously profitability should ramp up as well, and that's where we've seen that the price to earnings drop on a forward basis as well. Balance sheet as well, solid balance sheet, only a little bit of debt on there, 14% debt to equity. So I mean, you look at this company here, and even if you weigh in that it's a Chinese stock, I mean, every stock at some point has got a valuation where it's too cheap. And I think when you look at Alibaba, you could double the valuation up on the numbers they're going to do next year. And I think it still looks relatively good valuation at a discount to the market, which is what you want to really be owning, isn't it? The next one is Fiverr. So I dropped a full video on this one the other day, so I'll keep this one nice and brief. But as you know, I'm more bullish on small caps this year. Fiverr does come in that category at $1 billion company, $27. It's a stock that really benefited from the CV situation, and then because it had so much demand pulled forward, it really struggled for growth and the market sold it off. The fact that it's now trading at levels it was trading at below even the CV demand and the IPO now is just crazy for Fiverr, because you look at the growth that they've had since then. Like the revenue has 3x since that time frame, but yeah, it's cheaper. It's crazy. Now Fiverr, I'm sure most of you know, it's a service for freelance providers, so you can get certain work done through here through freelancers like graphics and design, programming, digital marketing. So if I wanted to potentially get someone to do my thumbnails, I could find someone to do my thumbnails here, and it tells me the rating, it tells me how long it takes them to do it, the price they potentially could do it in, and it's a really good platform. Now it is a competitive market, but when you think about the size of the market, it is going to be a competitive space because there's so much work out there. And from a freelance point of view, more workers are wanting to go freelance. There's an increase of people wanting to choose their own hours, what days they work. So it's an area that there's going to be growth in the amount of freelancers. And also when you look at a company's point of view, they don't want to pay someone 5 days a week when they can get someone to do a job that they can hire someone on Fiverr that will work 3.5 days a week, and they'll save money on employing a full-time staff member. So it works both ways. From people that are wanting to work freelance, which is increasing, Fiverr supports them, and from companies that want to save money, it supports them as well. So there's going to be big growth in this in the next few years. Now sure, there's going to be maybe competition, I agree, but there's competition in nearly every single area in the world in a massive market space, whether that be e-commerce, if it be healthcare, if it be fashion. And a few people say, oh, what about the AI situation? I think a few people are getting a little bit carried away about the whole AI situation. We're still going to need people doing these jobs for the next few years. And when you look at the recent earnings, the earnings have gone back to very good numbers. So the company has gone back to growth now, which is good. Really good gross margins, as you can see here. They're managing the cost. R&D wasn't up that much. Sales and marketing decreased, and revenue went up as well. G&A was a little increase as well, but you'll see here they're a company that as well used to be unprofitable and now starting to stick profitability in as well. And when you combine that all together, it means it's going to be a company that trades at around 13 times earnings and will grow double digit, which is very attractive to me. And the next stock is another Chinese stock. So I am going into a few people aren't fans of Chinese stocks, but I am seeing a lot of value there at the moment. And the next one is PDD Holdings. So obviously trades at a bit of a premium, which you don't normally see a Chinese stock trade at a premium, but when you look at the numbers, I think you can justify it. Now, originally they owned Pinduoduo. Now, this is a company that I liked, but I never wanted to invest in it on its own, and also they never had the profitability. What they have created now is they've got Pinduoduo, and they've also got a company called Temu. Now, this has come very popular around the world, and it's only been in existence for a year. Temu is a cheaper alternative from China for cheaper products. Now, they do take a little bit longer to get delivered, but what does everyone want at the moment? Everyone's being cost efficient. So people don't mind waiting for the little longer delivery to save a bit of money on these cheaper products. And because of that, it has been growing massive. If you look at the App Store at the moment, this is currently the #2 app in the US App Store. And if you look at Temu, it was only founded in July 2022, 1 year ago. And in that time frame, they have opened up in many countries. So they launched in Australia, New Zealand, France, Germany, Italy, Netherlands, Spain and the UK, and recently launched in Latin America. Now, if this is going to be a company that follows the kind of path that we've seen with Shein has been very popular because people are wanting to save money on cheaper clothes. And in the last few years, look at the growth that Shein has had, and in 2023 that's only going to continue, and in fact they're looking to IPO. So if this is the first year of Temu and they are putting in these numbers and they could copy Shein, it's going to be very good growth for them. And the good thing about PDD Holdings is if you look at the growth, very good, but they're also putting in good amounts of profitability as well. And that means as well, when you look on the balance sheet, you've got a very solid balance sheet inside this company, which is great. Now, when you look at the recent quarter was absolutely unbelievable, and that's what got me to buy this really. If you look at the EPS, massive beat on the EPS. So the profitability is going up and up more than what's expected. That means the company's going to come down in valuation a lot quicker. You look at the revenue growth, they beat by 2 billion on a 9 billion revenue, which is insane. I've not seen a company do that for ever, I don't think. 94% revenue growth as well. And then when you look at the profitability ramp up, when you look at the revenue ramp up as well, what that all means is you're going to be buying a company here at 20 forward times earnings. Now, normally you would say for a Chinese stock, 20 times forward earnings, I'm not sure. But when you look back at the numbers and you look at that balance sheet, you look at how much they're beating profitability, the Christmas period just ended, 94% revenue growth, it's not that bad at all. So I think it's worth paying up that little valuation when you look at the numbers they are doing. Now, there is a 6th stock that I have bought. However, I'm not going to reveal it today on this video because I only bought it last week and it's a brand new stock. So I've only just told the guys on the Patreon, and I thought it'd be very unfair for them, that are the biggest supporter of the channel, to reveal that straight away on the YouTube. So I will reveal this stock in probably maybe 2 weeks time, but there is a new stock into the portfolio, but I aren't going to reveal that today, but I will post it on YouTube. So there is that transparency there, so you've got to keep an eye out for that. And that moves me on to the stocks that I have been selling. As always, I don't quietly sell anything out in the background. I always let you know if I've done any sells in the last month, and I have. So there's been 3 sells in the last month, which is quite a big month for me. I don't normally sell that many, but it's just worked out that way. First one is JD.com. So I did sell JD.com, which I made a video on. A stock that did quite well for us. We bought, once again, back in 2018 when there was all that fear around China. I was selling this stock out at 300-400% profit, around about half my position. Held the rest thinking it was just going to have a nice little uptick from here. That didn't happen. The stock did go down massively. I was about break even on my position, and the only reason why I sold JD.com is so I could buy PDD Holdings. I thought this was a very good switch compared to JD.com. JD.com, less profitability. The company trades at 13 times earnings. 24 times earnings, I can pick up PDD. And what am I getting with PDD? I'm getting a company that's ramping up profitability faster, growing 94% year over year. I personally think this was a very good switch. So I did sell JD.com out for PDD, and also I didn't want to have that many Chinese stocks in my portfolio, so a bit of risk management going on there. The second stock that I didn't sell, I trimmed my position, that being the key word. I think sometimes people miss these words I say. So I trimmed the position in DraftKings. I did not sell the position in DraftKings. And the reason why is just to manage the portfolio. As you guys know, 2022, what was the stock that I was buying heavy? What stock was in nearly every video? DraftKings. I bought it, and I thought it was the best opportunity in the market. This year, the stock is up 219%. I'm now up on my position. The position has now become a massive part of my portfolio. A little bit too much, where I'm like, I don't want to have that much of my portfolio tied in DraftKings, because if anything was to go wrong, that would hurt massively. I don't think it will go wrong, but it's just a bit of risk management there. So I did decide to trim some more DraftKings. So I did take around about a 30% profit on that DraftKings sell. And that gives me the largest cash balance that I've actually had since 2021, which is very good. But yeah, a little bit of a trim there, which I'm absolutely fine with. And the last stock I sold, once again, I actually sold this last week. So I only sold this a couple of days ago. Same again, I think it's unfair for the guys on the Patreon that support the channel the most that I tell them something and then I've revealed it on YouTube like 3 or 4 days after it's happened. So once again, I will reveal the company that I did sell in a couple of weeks' time. And it was a position that I sold everything of. I sold all the shares in that position. I completely exited it. So yeah, I'll talk about that in a little bit. But those are the stocks that I have been buying in January 2024 and the stocks that I've been selling in January 2024. Hope you enjoyed the video, guys. Hit that like button. We're nearly there, 15,000 subscribers. Maybe we can get there after this video. Hope you enjoyed it. See you in a bit.